I have watched banks fail my entire life. I have seen small community banks disappear overnight. I have seen regional banks collapse in a matter of days. I have seen giant institutions that everyone thought were too big to fail brought to their knees. And I have learned something that most people never figure out. Bank failures do not happen randomly. They are not unpredictable acts of financial nature. There are warning signs that appear before every bank failure, patterns that repeat themselves with remarkable consistency, red flags that tell you a bank is in trouble long before the headlines announce the collapse. Today, I'm going to share what I've learned from decades of studying banks, investing in banks, and watching banks fail. If you understand these patterns, you will never be surprised by a bank failure again. You will see them coming, and you will protect yourself accordingly. Let me start with a fundamental truth about banking that most people do not understand. Banks are inherently fragile institutions. They operate on a business model that is fundamentally risky. Understanding this fragility is essential to understanding why banks fail. Here is how a bank works. They take deposits from customers. Those deposits are liabilities. The bank owes that money back to depositors whenever they want it. Then the bank takes those deposits and makes loans or buys securities. Those loans and securities are assets. The bank earns interest on those assets that is higher than the interest they pay on deposits. The difference is their profit. The problem is the mismatch. Deposits can be withdrawn immediately, but loans cannot be called back immediately. If enough depositors want their money at the same time, the bank cannot sell its loans fast enough to pay them. This is what we call a bank run, and it can destroy even a healthy bank. Banks manage this risk by keeping some cash on hand and by having access to borrowing facilities. But they cannot keep enough cash to pay all depositors at once. No bank can. The entire banking system is built on the assumption that not everyone will want their money at the same time. This fundamental fragility means that confidence is everything in banking. As long as people believe the bank is solid, they leave their money there. But the moment confidence cracks, the moment people start to worry, they rush to withdraw their funds, and that rush can become self-fulfilling. The bank fails, not because it was insolvent, but because the run made it impossible to meet withdrawals. I have watched this dynamic play out over and over throughout my career. The trigger varies, the details differ, but the underlying pattern is always the same. Confidence erodes, withdrawals accelerate, the bank cannot keep up, and failure follows. Now let me walk you through the specific warning signs that always appear before banks fail. The first warning sign is rapid growth, especially in risky lending categories. When a bank is growing its loan book at 20 or 30% per year, that is a red flag. Where are all these loans coming from? Either the bank is taking market share from competitors by offering better terms, which means they are probably pricing risk too cheaply, or they are lending to borrowers that other banks have rejected, which means they are taking on risk that others have avoided. Rapid growth in banking almost always means deteriorating underwriting standards. The easiest way to grow a loan book is to say yes to more borrowers, but saying yes to borrowers you should have rejected is a recipe for disaster when the economy turns. I saw this pattern clearly in the years before the 2008 financial crisis. Banks were growing their mortgage portfolios at extraordinary rates. They were approving loans to anyone who could fog a mirror. No documentation loans, adjustable rate mortgages with teaser rates, loans with negative amortization where the balance actually grew over time. These were not prudent loans, they were time bombs. And the banks that grew fastest in these categories, the ones that were celebrated for their growth and their market share gains, were the ones that failed most spectacularly when the housing market turned. Washington Mutual was one of the largest savings and loan institutions in the country. They grew aggressively in subprime and option arm mortgages throughout the 2000s. When housing prices fell, their loan losses were catastrophic. They became the largest bank failure in American history. Countrywide was the largest mortgage originator in the country, They approved almost any loan that came through the door. When defaults started rising, they could not survive. They were acquired by Bank of America in a fire sale. The pattern is consistent. Rapid growth, especially in risky categories, is a warning sign that trouble is coming. The growth creates the illusion of success while the risks are building beneath the surface. The second warning sign is concentration in a single sector or geography. Banks that put too many eggs in one basket are vulnerable to shocks in that basket. If a bank has half its loans in commercial real estate in one city and that real estate market crashes, the bank is in serious trouble. If a bank has most of its loans to one industry and that industry faces a downturn, the bank suffers disproportionately. I saw this with the Texas banks in the 1980s. When oil prices collapsed, the Texas economy went into recession. Banks that had concentrated their lending in oil and gas and Texas real estate were devastated. Hundreds of Texas banks failed. The ones that survived were the ones with more diversified loan portfolios. I saw this again with Silicon Valley Bank in 2023. They had concentrated their deposit base in technology startups and venture capital firms. When the tech sector cooled and these companies started drawing down their deposits, Silicon Valley Bank faced massive outflows. They could not survive. Concentration creates fragility. A diversified bank can absorb losses in one sector because other sectors remain healthy. A concentrated bank has no cushion. One bad bet can bring down the entire institution. The third warning sign is aggressive accounting and earnings management. Banks have enormous discretion in how they report their financial results. They decide how much to set aside for potential loan losses. They decide how to value securities on their books. They decide when to recognize gains and losses. When a bank is consistently at the aggressive end of these choices, when they are minimizing reserves and maximizing reported earnings, that is a warning sign. They may be painting a prettier picture than reality warrants. Loan metric I watch closely is the allowance for loan losses relative to non-performing loans. A healthy bank keeps reserves equal to or greater than its troubled loans. A bank that is under-reserved is betting that losses will not materialize. If they are wrong, the losses will hit all at once. Another metric is the trend in charge-offs. If a bank is writing off fewer loans than its peers despite having similar lending profiles, either they have discovered some secret to better underwriting, or they are delaying the recognition of losses. The latter is more common before the 2008 crisis. Many banks were reporting record earnings even as the housing market was deteriorating. They were not reserving adequately for the losses that were coming. They were using accounting choices to hide the gathering storm. When the losses finally hit, they were far larger than anyone had expected based on the reported financials. The fourth warning sign is heavy reliance on short-term or volatile funding sources. Remember the fundamental fragility I described earlier. Banks borrow short and lend long. They depend on depositors leaving their money in place. When funding sources become unstable, the bank becomes unstable. Some funding sources are more stable than others. Retail deposits from individual customers are generally sticky. People do not move their checking accounts frequently. They have direct deposits and automatic bill payments set up. Switching banks is a hassle. But wholesale funding, money borrowed from other financial institutions or large institutional depositors, can disappear overnight. These lenders are sophisticated. They watch for signs of trouble, and when they get nervous, they pull their money immediately. Banks that rely heavily on wholesale funding are vulnerable to sudden stops. If the market loses confidence in them for any reason, their funding can evaporate before they have time to react. Northern Rock in the United Kingdom was heavily dependent on wholesale funding. When the mortgage market started showing stress in 2007, wholesale lenders pulled back. Northern Rock could not replace the funding fast enough. They experienced the first bank run in Britain in over a century. Uninsured deposits, deposits above the insurance limit, are also volatile. Large depositors have the sophistication to monitor bank health and the ability to move their money quickly. When Silicon Valley Bank started showing stress, uninsured depositors fled en masse. 90% of their deposits were uninsured, and those deposits headed for the exits. The fifth warning sign is deteriorating asset quality that management explains away. When a bank's non-performing loans start rising, when charge-offs increase, when past due loans grow, these are objective signs of trouble. How management responds to these signs tells you a lot. Good management acknowledges problems early. They increase reserves. They tighten underwriting. They work aggressively to resolve troubled loans. They are honest with investors about the challenges they face. Bad management makes excuses. They blame temporary factors. They claim the problems are isolated. They point to accounting technicalities. They assure investors that everything is under control. I have learned to be very skeptical when bank management dismisses rising problem loans. The problems are almost always worse than management initially admits. If they are making excuses when problems are small, imagine what they will do when problems grow larger. Before the savings and loan crisis of the 1980s, many thrift executives insisted that their institutions were fundamentally sound, even as interest rates rose and their loan portfolios deteriorated. They blamed regulators. They blamed the economy. They blamed everyone but themselves. And then they failed by the hundreds. The sixth warning sign is regulatory actions or increased regulatory scrutiny. Bank regulators examine banks regularly. They have access to information that the public does not see. When regulators take action against a bank, when they issue enforcement orders, when they require increased capital, when they restrict certain activities, these are serious warning signs. Regulators are not in the business of creating panic. They generally try to work with troubled banks quietly. If they are taking public action, the problems are likely more severe than what is publicly known. I pay attention to regulatory filings and enforcement actions. A bank that is subject to a cease and desist order or a memorandum of understanding with regulators is a bank with serious problems. Even if the bank's public statements are reassuring, the regulatory action tells you that professionals who have seen the books are concerned. The seventh warning sign is management turnover, especially sudden departures of key executives. When the chief financial officer suddenly resigns for personal reasons, I get nervous. When the chief risk officer leaves unexpectedly, I pay attention. When there is a pattern of senior departures, I assume something is wrong. Executives have careers to protect. They generally do not leave good situations. When they leave suddenly, especially without clear next steps, it often means they see trouble coming and want to distance themselves. The departure of auditors is even more concerning. If a bank's external auditor resigns or is replaced, that is a major red flag. Auditors have seen the books. If they are walking away, they may have discovered something they do not want their name associated with. The eighth warning sign is a stock price that is diverging from peers. The market is not always right, but the market often knows things before they become public. If a bank's stock price is falling while its peers are stable or rising, the market may be sensing problems that are not yet visible in the financial statements. I do not rely solely on stock prices. Markets can be wrong. Stocks can be mispriced for reasons unrelated to fundamentals, but a significant divergence from peers is worth investigating. What does the market see that might not be apparent from public disclosures? In the months before Silicon Valley Bank failed, its stock price had fallen significantly from its highs. The market was worried about the unrealized losses in its bond portfolio and the concentration of its deposit base. Those worries turned out to be justified. Let me talk about how these warning signs combine and interact. No single warning sign necessarily means a bank will fail. A bank can grow rapidly and survive if its underwriting is sound. A bank can have concentration and survive if that sector remains healthy. A bank can rely on wholesale funding and survive if confidence remains strong. But when multiple warning signs appear together, the risk multiplies. A bank that is growing rapidly in a concentrated sector with volatile funding and aggressive accounting is a bank in serious danger. The warning signs reinforce each other. Each problem makes the others worse. This is why bank failures often seem to come out of nowhere. The problems have been building for years, hidden by good times and aggressive accounting. Then something triggers a reassessment, confidence cracks, and suddenly everyone can see what was there all along. Let me share some case studies that illustrate these patterns. Washington Mutual grew aggressively in subprime mortgages and option arms throughout the 2000s. They were concentrated in the hottest housing markets. Their accounting was aggressive, minimizing loss reserves. When housing prices started falling, their loan losses exploded. Depositors fled. They were seized by regulators and sold to JP Chase in September 2008. Every warning sign was present: rapid growth, concentration in risky categories, aggressive accounting. Volatile funding as depositors withdrew management that minimized problems. The failure was predictable to anyone watching the warning signs. Lehman Brothers was not technically a bank, but the same patterns applied. They grew aggressively in mortgage-backed securities and commercial real estate. They were heavily concentrated in those sectors. Their leverage was extreme. Their funding was largely short-term and wholesale. When confidence cracked, they could not survive. Their failure in September 2008 triggered the worst of the financial crisis. Silicon Valley Bank grew rapidly alongside the tech boom. They were concentrated in technology company deposits and long-duration bonds. When interest rates rose, their bond portfolio lost value. When the tech sector cooled, their deposits started leaving. Their uninsured depositors fled when they saw the problems. Within days, the bank was gone. First Republic followed a similar pattern. They catered to wealthy clients with jumbo mortgages and private banking. They grew rapidly. They were concentrated in high-cost markets. When Silicon Valley Bank failed, confidence in similar banks evaporated. First Republic's depositors fled despite the bank's actual condition being arguably better. The run was driven by fear, and fear can be contagious. Now let me share how I think about bank investments in light of these patterns. I have owned bank stocks throughout my career. I owned significant positions in Wells Fargo for many years. I own Bank of America today. I have made money in banks, but I approach bank investments with caution because I understand the inherent fragility. When I evaluate a bank, I start with the questions the warning signs suggest. Is the bank growing faster than makes sense? Is there concentration that creates vulnerability? Is the accounting conservative or aggressive? What is the funding structure? How is management responding to any problems? I also look at the capital position. A well-capitalized bank can absorb losses that would destroy a thinly capitalized bank. Equity is the cushion that protects depositors and allows the bank to survive mistakes. I want banks with robust capital ratios well above regulatory minimums. I look at the quality of the deposit franchise. Banks with sticky retail deposits from long-term relationships are more stable than banks dependent on rate-sensitive deposits or wholesale funding. The deposit base is the foundation of a bank's stability. I look at the management team. Do they have experience managing through difficult times? Are they honest about problems? Do they have a track record of conservative underwriting? Management quality matters enormously in banking because the decisions they make today determine the losses that appear years from now. And I insist on a margin of safety. I do not pay premium prices for banks because the downside in banking can be severe. A bank stock can go to zero if the institution fails. I want to buy at prices that give me protection if things go wrong. Let me also discuss what individuals should think about regarding the banks where they keep their money. For most people, bank deposits are protected by deposit insurance in the United States. The FDIC insures deposits up to $250,000 per depositor per institution. If your deposits are within this limit, you will get your money back even if the bank fails. But the process can be disruptive. If your bank fails, you may lose access to your funds for days. Automatic payments may not go through. Checks may bounce. The inconvenience can be significant even if you do not lose money. If you have deposits above the insurance limit, you have real risk. Uninsured depositors sometimes recover their full balances if the bank is acquired, as happened with Silicon Valley Bank, but this is not guaranteed in some failures. Uninsured depositors have taken losses. My advice is simple. Keep your deposits within insurance limits. If you have more than $250,000, spread it across multiple institutions. The small inconvenience of managing multiple accounts is worth the protection. Also, pay attention to the health of your bank. You do not need to do sophisticated analysis, just be aware. Is the bank growing unusually fast? Is it offering rates significantly higher than competitors, which might indicate desperation for deposits? Is there news about regulatory problems or management turnover? These basic observations can alert you to potential issues. Let me close with some broader thoughts about banking and financial stability. Bank failures are not just problems for the banks and their shareholders. They can create broader economic damage. When banks fail, credit contracts, businesses that depended on those banks for loans may not be able to get financing elsewhere. Employees lose jobs. Communities suffer. This is why we have bank regulation and deposit insurance. The system is designed to prevent failures when possible and contain the damage when failures occur. The system is not perfect, as we saw in 2008, but it has prevented the kind of cascading failures that caused the Great Depression. As an investor and as a citizen, I believe in a stable banking system. I want banks to be boring. I want them to make sensible loans, maintain adequate capital, and manage their risk conservatively. The exciting banks, the ones growing rapidly and taking risks, are the ones that eventually fail. The warning signs I have described today are not secrets. They are visible to anyone who looks. The problem is that during good times, people do not want to look. They want to believe that growth will continue and risks will not materialize. They want to enjoy the profits without thinking about the potential losses. But the risks are always there. The patterns always repeat. And the banks that ignore the lessons of history are doomed to become the next case study in failure. My hope is that by understanding these patterns, you can protect yourself, keep your deposits within insurance limits. Be skeptical of banks that are growing aggressively or offering unusually high rates. Pay attention to the warning signs. And if you invest in banks, do so with eyes open. Understand the fragility inherent in the business model. Insist on conservative management and strong capital. Do not pay prices that assume everything will go perfectly. Bank failures are not random. They are predictable. The warning signs are there for anyone willing to see them. The only question is whether you will pay attention before it is too late. That is what 80 years of watching banks has taught me. The patterns are consistent. The warning signs are reliable, and the consequences of ignoring them are severe. Learn from history. Watch for the warning signs and protect yourself accordingly. That is the best advice I can give. Let me share some additional lessons that I think are important for understanding bank failures. One pattern I have observed is that bank failures often cluster. They do not happen one at a time in isolation. They happen in waves. When one bank fails, confidence in similar banks erodes. Depositors and creditors start looking more carefully at other institutions. Problems that were overlooked become impossible to ignore. We saw this in the savings and loan crisis of the 1980s. When over 1,000 thrifts failed, we saw it in 2008, when the entire banking system came close to collapse. We saw it in 2023 when Silicon Valley Bank's failure triggered runs on other regional banks. This clustering happens because bank failures reveal information. When one bank fails because of problems in commercial real estate, Investors start wondering which other banks have similar exposures. When one bank fails because of uninsured deposit flight, depositors at other banks start checking whether their deposits are insured. The clustering also happens because bank failures tighten credit conditions broadly. When banks are worried about their own survival, they stop lending. This can push marginal borrowers into default, which creates losses at other banks, which makes those banks more cautious, which creates more defaults. The system can spiral downward. This is why I pay attention not just to individual bank warning signs, but to systemic warning signs. Are there problems building across the banking system? Are multiple banks showing the same vulnerabilities? Is there a common exposure that could trigger cascading failures? In the years before 2008, the common exposure was housing. Banks across the country had loaded up on mortgage risk, both directly through loans and indirectly through mortgage-backed securities. When housing prices started falling, it was not a problem for one bank. It was a problem for the entire system. Today, I watch commercial real estate carefully. Many banks have significant exposure to office buildings and retail properties. The shift to remote work and e-commerce has fundamentally changed the economics of these properties. Vacancy rates are elevated. Values have fallen. If losses in commercial real estate cascade through the banking system, we could see another wave of failures. I also watch interest rate risk. Banks hold large portfolios of bonds and loans that were originated when interest rates were much lower. As rates have risen, the market value of these assets has fallen. For banks that have to sell assets to meet withdrawals, these unrealized losses become real losses. This is what happened at Silicon Valley Bank. The lesson is that individual bank analysis is necessary but not sufficient. You also need to understand the systemic context. A bank that looks healthy in isolation can be swept away by a systemic crisis. Let me also discuss the role of contagion in bank failures. Bank runs can be contagious. When people see one bank failing, they start worrying about other banks. Even if those other banks are fundamentally healthy, the fear can trigger withdrawals, and enough withdrawals can make a healthy bank unhealthy. This contagion is why regulators work so hard to contain bank failures quickly. They want to prevent the fear from spreading. They want to reassure depositors that other banks are safe. They want to stop the contagion before it starts. The speed of modern communication has made contagion more dangerous. In the old days, news of a bank failure spread slowly. People had time to think. Regulators had time to respond. Today, news spreads instantly. Social media can amplify fears. Depositors can move money with a few taps on their phone. Silicon Valley Bank experienced the fastest bank run in history. In a single day, depositors tried to withdraw over $40 billion. That is a rate of withdrawal that no bank could survive. The speed was enabled by technology, both the technology that spread the alarm and the technology that allowed instant transfers. This speed creates a new kind of fragility. A bank can be destroyed by a social media firestorm before regulators even understand what is happening. The old playbook of quietly working with troubled banks may not work when information moves this fast. I do not have a solution to this problem. It is a feature of our modern financial system. But I think depositors and investors need to be aware of it. A bank that seems healthy can be brought down by contagion in days or even hours. The old comfort that regulators will step in and fix things may not apply when events move faster than regulators can respond. Let me talk about what happens after banks fail, because I think this is instructive. When a bank fails, regulators typically try to arrange an acquisition by a healthy bank. The acquiring bank takes over the deposits, often with a loss-sharing agreement where the government absorbs some of the loan losses. This is the least disruptive outcome. Depositors wake up on Monday and their bank has a new name, but their money is still there when no acquirer can be found. The FDIC takes over the bank and begins paying out insured deposits. This process typically happens quickly, often over a weekend. Insured depositors usually have access to their money within a few days. Uninsured depositors have a more uncertain fate. They become creditors of the failed bank's estate. They may recover some or all of their money, depending on how much value can be recovered from the bank's assets. But this process can take months or years, and the recovery is never guaranteed. Shareholders typically lose everything. When a bank fails, equity is wiped out. This is appropriate. Shareholders took the risk and earned the rewards when times were good. They should bear the losses when things go bad. The resolution process is designed to protect depositors and maintain confidence in the banking system. But it is not painless. There are real costs and real disruptions. The best outcome is to avoid being in a failing bank in the first place. Let me share some thoughts on how regulators try to prevent bank failures. Bank regulators use a variety of tools to promote safety and soundness. Capital requirements force banks to maintain cushions against losses. Liquidity requirements ensure banks have enough liquid assets to meet withdrawals. Supervision involves regular examinations where regulators review the bank's loans, operations, and risk management. When regulators identify problems, they can take escalating actions, informal supervisory guidance, memoranda of understanding requiring corrective action, formal cease and desist orders, removal of management, and ultimately closure of the institution. The system works reasonably well most of the time. The vast majority of banks are well managed and well regulated. Failures are relatively rare when they do occur. The resolution process usually protects depositors and contains the damage. But the system has limitations. Regulators cannot see everything. Banks can hide problems through accounting choices and selective disclosure. Regulators may be slow to act because of political pressure or institutional inertia, and some problems only become visible when it is too late. The 2008 crisis revealed major gaps in the regulatory system. Important institutions like investment banks and mortgage companies were outside the traditional regulatory framework. Risks in complex financial products were not well understood. Regulators failed to appreciate the systemic implications of housing market declines. Since then, the regulatory framework has been strengthened. Capital requirements are higher. Stress tests evaluate whether banks can survive severe scenarios. Resolution planning requires large banks to have strategies for orderly failure. But no regulatory system can prevent all failures. The inherent fragility of banking means that failures will continue to occur. Let me discuss how my thinking about banks has evolved over my career. Years in my career, I was more willing to invest in banks. I understood the basic business model. I could evaluate the quality of loan portfolios. I saw opportunities to buy good banks at attractive prices. Over time, I have become more cautious. The 2008 crisis reminded me how quickly a bank's apparent strength can evaporate. The complexity of modern banking makes it harder to truly understand what is on the books. The speed of potential runs creates new vulnerabilities. I still own bank stocks. Bank of America is a significant position, but I approach these investments with humility. I know that even with careful analysis, I can be surprised. I maintain position sizes that allow me to survive being wrong. I am also more focused on the quality of the deposit franchise. Banks with strong retail deposit bases, with deep customer relationships, with sticky deposits that do not flee at the first sign of trouble. These are the banks I want to own. The deposit franchise is the foundation of stability in banking, and I insist on conservative management. I want bankers who remember that their primary job is not to maximize profits, but to protect depositors. Bankers who maintain strong capital even when competitors are running leaner. Bankers who say no to risky loans even when saying yes would boost short-term earnings. The best banks are boring. They grow modestly. They underwrite carefully. They maintain strong reserves. They do not chase the latest fad. They may not generate the highest returns in good times, but they survived the bad times. That survival is what creates long-term value. Let me end with some thoughts about what all this means for the average person. Most people do not invest in bank stocks, but everyone uses banks. Understanding how banks work and how they fail is important for protecting your own money. First, know the deposit insurance limits. In the United States, $250,000 per depositor per institution. Keep your deposits within these limits. If you have more, spread it across multiple banks or use different ownership categories that each qualify for separate insurance. Second, pay attention to your bank. You do not need to be an expert, but notice if your bank is in the news for problems. Notice if they are offering unusually high rates, which might signal desperation for deposits. Notice if there are signs of instability. Third, have a backup plan. Keep accounts at more than one bank. If your primary bank has problems, you want access to funds elsewhere. The inconvenience of managing multiple accounts is small compared to the disruption of losing access to your money. Fourth, understand that no bank is too big to fail in the sense of being immune to problems. Large banks may be rescued by the government, but that does not mean you will not experience disruption. It does not mean the stock will not go to zero. Size is not the same as safety. Fifth, be skeptical of promises and reassurances. When a bank says everything is fine, that may be true, or it may be the kind of statement that always precedes failure. Trust but verify. Look at the objective indicators, not just the public statements. The banking system is a remarkable achievement. It allows strangers to pool their savings and fund productive investments. It enables the economic activity that creates prosperity. We should appreciate what banks do well, but we should also understand their fragility. Banks fail. They always have and always will. The warning signs are visible to those who look, and the consequences of ignoring those signs can be severe. I have spent 80 years learning these lessons. The patterns are consistent. The warning signs are reliable. The banks that fail are almost always the ones that ignored the fundamentals of sound banking. Be aware, be cautious, protect yourself. And remember that in banking, the most dangerous words are, "This time is different." It never is.